This is Paul Donovan from UBS's Global Economics Department. It is the end of the world as we know it. Events this weekend mark not only a shift in terms of cyclical events in the global economy, but in all probability will be pointed to as a structural break in global financial markets. For 2 decades, financial assets have been reveling in a trend of declining risk premia, with the attendant reduction in the real cost of capital and associated increases in trend returns and trend growth. After this weekend's events, it seems inevitable that there will be a structural increase in risk premia to be applied to assets in future years beyond the limits of this crisis. The way in which markets react, trend rates of growth, and market interpretation of where normal value lies will be different in the next 10 years from where they have been in the last 10 years. We have tarnished the new golden age. Over the weekend, we had 3 critical developments. Bear Stearns has been acquired by JP Morgan at $2 a share. The critical development here is that the deal has been backed by a credit facility from the Federal Reserve, which in effect has utilized its own balance sheet to resolve an immediate solvency crisis. With little more than a day before the FOMC meets, the Fed has cut the discount rate a quarter point to 3.25% and expanded the term over which it will lend money to 90 days. Finally, the Fed has expanded the collateral that it will receive in exchange for funds to include investment-grade corporate securities, municipal securities, and mortgage-backed securities. We expect the Federal Reserve to cut interest rates at least 75 basis points this week, and a 100 basis point easing is also probable, given the credit market reaction to events. Credit spreads have remained wide. These measures should be seen as treating the symptoms of the current crisis, not effecting a cure for the underlying problem. That this is taking place is to be welcomed. The alternative is too horrific to contemplate. Swap spreads in Asia have tightened in, as is inevitable, given that the Fed is providing liquidity against a broader pool of collateral and reducing the need for the financial system to seek liquidity from elsewhere. However, capital adequacy in the broader financial system is not being addressed. The root cause of falling asset values is not being addressed. The risk of additional asset classes presenting problems to the financial system are also not addressed. In the absence of policy action in these areas, it seems unlikely that financial markets will normalize, though the extremes of volatility may be reduced. From an economic perspective, there are 3 points to stress. First, this is not an injection of surplus liquidity. Fed action to date is injecting liquidity in response to an increase in liquidity demand. As such, this accommodation must not be interpreted as being inflationary. Instead, the Fed is trying to avert a critical deflation threat. Second, events, though originating in the United States, stress the global nature of the economic consequences. Bank credit standards are tightening and will tighten further as a result of these events, and that includes European as well as American banks. As a result, the economic consequences of credit contraction will be felt on both sides of the Atlantic and may even have some ramifications in Asia. Central banks, the ECB and the Bank of England in particular, will have to respond to the economic consequences of tighter credit conditions. We have long expected the ECB and the Bank of England to ease rates further as tightening credit conditions weaken their economies. Events in markets today increase the pressure for that accommodation from both a financial and ultimately from a fundamental perspective. Third, much of the economic data will not reflect these financial system changes for a month or two. Sentiment is likely to be affected quickly, but real economic numbers will respond with a lag. First, the credit system will have to react, and then that reaction will have to be transmitted to firms and to households, who finally will then have to change their behavior. In the meantime, markets will be sensitive to housing and to credit numbers and high-frequency indicators of sentiment to the extent that fundamentals have any impact at all this week. Currency markets have moved predictably and violently in response to what is happening. However, it would be hard to characterize them as being disorderly at the moment. We think foreign exchange intervention is relatively unlikely in the absence of more dramatic moves. Today marks the 5th anniversary of the last time the Japanese authorities intervened in the markets, and Finance Minister Nakada has said specifically that there are no plans to stop yen appreciation at the moment. That's all for today. Good luck.